Hello, everyone. My name is Drew Coleman, and I'm a financial advisor with the Next Level Planning Group. Welcome, and maybe even welcome back to our third session in our new 10-part series titled 10 for 10. This new series is based upon the idea that less is more. The format of this video is to do a deep dive, spending roughly 10 minutes on one topic, which is in contrast to some of our other videos, which tend to be 30 to 60 minutes covering a variety of topics. Today, our focus will be dividend income. Now, prior to jumping into the topic, I want to share with you a few disclosure slides. So let's start with the basics. What's a dividend? Well, dividends are regular payments of profit made to investors who own a company's stock. And it should be noted too that not all stocks pay dividends. Now, each year, a company has to make decisions of what to do with their profits. And sometimes those decisions are, well, let's keep the profits and reinvest them for the growth. Other times the decisions are, well, let's keep the profits for the plans for future growth. And another decision might be, let's pay out some of those profits in the form of a dividend. And not all the profits are paid out, but a portion of them are paid out in the form of dividends. And there's no guarantee that a company will keep paying dividends just because they have. Sometimes stocks and companies that issue dividends have to reduce or eliminate those dividends. So on one level, it's either good nor bad if a company pays a dividend or doesn't pay a dividend. The dividend just represents a part of the total return that an investor experiences as a stock investor. So on this concept of total return, let's spend a few moments understanding what this is. It can be a very helpful thing to understand. And total return is just simply the combination of capital appreciation and dividends. When you invest in a stock, what you experience is that total return. And for a dividend paying stock, well, part of that total return is the dividend. And the other part of that total return is the capital gain. The two of them represent the total return. So in this example, you can see that possibly a stock has grown in value. It's appreciated. In this case, it's $7 of gain. At the same time, too, it's paid out a $3 dividend. So that $10 total return is a function of two pieces, the growth and then also the dividend. And examples of companies that pay dividends are Johnson & Johnson, Procter & Gamble, and Bank of America. But as I said before, not all companies pay dividends. Some are non-dividend paying stocks. And there, the source of return is purely capital appreciation. It's purely the growth of the stock price. Examples of non-dividend paying stocks are Amazon and Berkshire Hathaway. And these companies like to reinvest back into the company all of their dividends to use it for future growth. And here, the takeaway I want you to have is it's important to understand as an investor, and particularly a stock investor, where are the sources of return? Am I going to get my return exclusively from growth or from a combination of growth and dividend income? And with that, let's take a look at the options. If you are investing in a stock and that stock pays out a dividend, you really have two choices here. You can elect to receive the dividend as income and perhaps have it arrive in your checking account on a regular basis, or instead you can elect to reinvest that dividend and reinvest the dividend income. So let's look at two different scenarios. The first one is a hypothetical stock paying a 10% dividend annually. To keep things simple, let's assume a couple things. The stock price is $10, and that stock price remains unchanged throughout this 10-year period, and you start with 10,000 shares. So in the scenario of receiving a dividend as a cash payment annually, this investor receives $500 each year, and the account value during this 10-year period remains constant at $100,000 because it's 10,000 shares, and each share remains at $10. And at the end of the 10-year period, the investors received $5,000 of dividends, and the portfolio continues to be worth $100,000. So the investor has $105,000 of total value at the end of this 10-year period. Now, in the scenario of an investor reinvesting dividends back into more shares, the investor uses that cash dividend not as income, but as a means to buy more shares of stock. And so every year that investor takes that dividend and says, no, buy some more shares of stock. And as you look in the column titled additional shares purchased, you'll see that that amount is increasing because the share count increases. It starts at 10,000, then it's 10,050, then it's 10,100 as that investor is accumulating more and more shares. And so at the end of the 10-year period, this investor has a total account value of $105,114, and the share count has increased by 511 shares. And if you look at these two different scenarios, you can see that the second scenario is slightly larger by $114. And the reason for this difference is that the first investor was harvesting part of the total return and pocketing each year, whereas in the second example, all the total return was being reinvested to compound each year, resulting in a slightly higher outcome than the first. So a question you might be asking is, well, should dividends be reinvested or should dividends be distributed as cash? It's a good question, and the answer depends on an investor's unique situation. However, broadly speaking, the decision to reinvest or not can boil down to age. And like I said, this is just broadly speaking. There are many, many nuances to consider. If you are in a category of working and saving and investing and thinking about a retirement in the future and trying to build your wealth for that endeavor, it's likely best to reinvest your dividends and use those dividends to purchase more shares of stock to build your wealth and your portfolio so you can someday retire. If, however, you are in the retirement stage of life, living off of your investments, you may want to take a different path and receive those dividends as a means of creating cash flow and income to support your retirement. Of course, one concern in retirement is running out of money. But if you're only spending your dividend income and not the principal of your portfolio, your principal isn't being touched. And that's the beauty of receiving dividends of income and leaving your principal alone. So for example, if you've got a $1 million portfolio that has a 4% dividend yield, that portfolio will generate $40,000 of income for you. And the bigger the portfolio, the larger the amount of the income. But how reliable are dividends as a source of income, especially if you're depending upon them to pay your bills in retirement? After all, companies can cut their dividends due to declining earnings or even because of mounting debt. What about the stock market and its declines? Can falling stock prices result in falling dividends? These are legitimate concerns. And the chart on this page offers true insights to these issues. Let's take a look at the history of the dividend income in the S&P 500 index. What this chart reveals is that since 1871, the inflation-adjusted annual dividend per share of the S&P 500 index has increased from $6.18 to $68.21. From 1871 to 1947, the annual dividend was choppy. And there are periods of rising and falling income. But since 1947, the annual dividend has been on an upward trajectory, rising from $9.93 to $68.21, including adjustments for inflation. So what's apparent from this chart is that the dollar amount of the annual dividend does not increase every year, and in fact can decline. For example, in 2008, the annual dividend reached $40.62 and then fell to $31.21 and didn't recover fully until 2012. The data reveals that since 1947, the annual dividend payout has declined 38% of the time. This means that the amount of money an investor received was less than the following year 38% of the time. Now that might seem like a big deal, but those declines are small in comparison to the overall rise in the total amount of dividend income paid from the S&P 500 from 1947 to 2023. The total increase was an inflation-adjusted $58.28, which translates to an annual increase of 2.53% per year. So even though there are ups and downs, and even though sometimes you receive less income in subsequent years, the annual amount of dividend payout increases at a pretty good clip, but it can rise and fall each year. So what are the key insights? What do I want to share with you? Well, dividends represent part of the total return of a stock or stock fund investment. Dividends can be reinvested or received as cash. And lastly, dividends can be an essential part of investors' diversified portfolio and part of their overall plan to generate income in retirement and other phases of life. So thank you for attending. I hope you found this enjoyable. Look forward to sharing with you future segments of our 10 for 10 session.